The general ledger is the central repository of an accounting system in which all financial transactions are classified and accumulated using the principles of double-entry bookkeeping. Journal entries provide the initial formal record of transactions before they are transferred, posted, to individual ledger accounts. Together, journals and ledgers ensure that accounting records remain complete, accurate, and capable of producing reliable financial statements. The program emphasizes that understanding ledger accounts and journal processing is fundamental to maintaining accounting records and preparing financial statements in accordance with IFRS accounting standards. 1. General ledger accounts. Nature and function. The general ledger contains all accounts used to record an entity's financial transactions. Each account summarizes movements relating to a specific asset, liability, equity item, income category, or expense category throughout the accounting period. The ledger serves several essential functions: classifying financial transactions systematically, maintaining complete accounting records, supporting preparation of the trial balance, providing information for financial statement preparation, establishing an audit trail for verification and control. Every ledger account records increases and decreases through debit and credit entries, preserving the equality of the accounting equation. Main types of general ledger accounts. Assets. Asset accounts record economic resources controlled by the business, including cash, bank inventory, trade receivables, property, plant, and equipment. Assets normally carry debit balances, increasing by debits and decreasing by credits. Liabilities. Liability accounts represent obligations owed to external parties, including trade payables, bank loans, tax payable, accrued expenses. Liabilities normally carry credit balances, increasing by credits and decreasing by debits. Equity. Capital. Equity represents the owner's residual interest in the business after deducting liabilities from assets. Examples include share capital, retained earnings, owner's capital reserves. Equity accounts generally possess credit balances. Income. Revenue. Income accounts record economic benefits generated through ordinary business activities. Examples include sales revenue, service income, interest income. Revenue increases equity and therefore normally has credit balances. Expenses. Expense accounts record costs incurred in generating revenue. Examples include wages, rent, utilities, depreciation, insurance. Expenses reduce equity and therefore normally have debit balances. The classification of transactions into these 5 account categories enables accurate preparation of financial statements. 2. Initial recording of financial data. Financial information enters the accounting system through source documents, such as invoices, receipts, purchase orders, payroll records, and bank statements. The recording process typically follows these stages. Economic transaction occurs. Supporting documentation is prepared. Transaction is analyzed. Journal entry is created. Journal entry is posted to the general ledger. Ledger balances are summarized in the trial balance. Financial statements are prepared. This structured process ensures completeness, accuracy, and traceability throughout the accounting cycle. 3. Journal entries and posting to general ledger accounts. A journal is the book of original entry where transactions are recorded chronologically before classification into ledger accounts. Each journal entry follows the double entry principle. One or more debit entries, one or more credit entries, total debits always equal total credits. For example, purchasing inventory for cash. Dr. Inventory. Cr. Cash. The journal records the transaction first, after which the amounts are posted to the relevant ledger accounts. Posting transfers each debit and credit from the journal into the appropriate account within the general ledger, allowing cumulative balances to be maintained throughout the accounting period. Journal entries therefore provide both chronological recording and documentary support for ledger postings. 4. Identifying appropriate journals. Different business transactions require recording in different journals depending on their nature. The general journal is commonly used for transactions that cannot be recorded in specialized journals, including depreciation, accruals, prepayments, corrections of errors, and opening balances. Correct journal selection ensures efficient transaction processing and effective internal control. 5. Balancing and closing general ledger accounts. At the end of each accounting period, ledger accounts must be balanced to determine their closing balances. Balancing involves calculating total debits and total credits, determining the difference between the two sides, inserting the balancing figure to equalize both totals, carrying the closing balance forward as the opening balance for the next accounting period where appropriate. For asset, liability, and equity accounts, balances are normally carried forward into the subsequent period because these represent continuing financial position items. In contrast, income and expense accounts are temporary accounts. Their balances are transferred to the statement of profit or loss, effectively closing them at year-end before beginning the next accounting period with zero balances. This closing process enables the calculation of annual profit or loss while ensuring that only balance sheet accounts continue into the following financial year. General ledger accounts and journal entries provide the core recording mechanism of the double-entry accounting system. Source documents initiate journal entries, journals record transactions chronologically, and ledger accounts classify transactions systematically to facilitate trial balance preparation and financial reporting. Proper journal processing, accurate posting, and systematic year-end balancing ensure that accounting records remain complete, internally consistent, and capable of producing reliable financial statements that comply with IFRS accounting standards and accepted accounting principles.